Crypto products and NFTs are unregulated and can be highly risky. There may be no regulatory recourse for any loss from such transactions.
Hello and welcome to ETMarkets Crypto Q&A. I'm Aloni Bhatt. Today we have Parth Chaturvedi, lead crypto ecosystem at CoinSwitch Kuber, who will respond to all your questions. Now, Parth is a crypto native since 2018, and before his role at CoinSwitch, he was a management associate at FalconX, which is a digital asset trading platform headquartered in the US.
Hello everyone. Hi, this is Parth from CoinSwitch Kuber. I lead the crypto ecosystem here. And as you might know, we've been doing this series in terms of educating people around different basic cryptocurrency and Web3 concepts. Today's concept is, topic is very interesting. It's because today we discuss on how to do your own research in cryptocurrency or the general Web3 space. And there's in fact like a very unique term for this in crypto slang, which is called DYOR, or do your own research. And it sort of has become like the go-to mantra for people, to give you an investment advice in the crypto asset space. So first of all, I would like to begin with as to why there's been a huge interest in crypto as an asset class, especially amongst the youth in India, and being an unregulated marketplace that is there's a lack of reliable information. It becomes very important to educate yourself before diving in for the high profits. So, what is my advice for young people entering the space? So, first of all, you need to understand that investing in crypto is very different from investing in other asset classes, and especially stocks. Like people do that comparison pretty often. You need to understand that this is a technological shift that is happening, and you need to understand what is the utility of the underlying digital asset that you are investing in. What will be the tokenomics of that digital asset in the future? So these three parameters, what is the use case of the technology trying to solve? What will be the utility of the digital asset, and what are the tokenomics? These three make every crypto project different from the other. So for somebody who's starting in the space, they should first try to understand, the main two projects that form the fundamental or the backbone of the entire crypto industry, which is Bitcoin and Ethereum. Again, for this, you have to take historical context. Bitcoin was the first ever, blockchain network that began in 2009, and it still continued for, almost a period of about 12 years now. That was the first blockchain network that was focused on making peer-to-peer transactions without any intermediary. The next major upgrade in terms of technology was Ethereum, which sort of added a new layer to this whole decentralized network by bringing on smart contracts. What are smart contracts? They are self-executing, contracts that basically take inputs from external sources and then auto-execute them. Because of smart contracts, Ethereum sort of became like a decentralized computer on which different decentralized apps could be run. So fundamentally understanding these two projects can really create a good framework for you to build your crypto investment thesis. Primary advice to any users or any investor who's entering the space, they need to understand what the project is trying to solve for. Not believe everything that you've heard on social media or some influencers telling you to buy this particular token. You have to go and understand the token in detail as to what it's trying to solve. And for that, probably the first source for each project is its white paper, where they lay out details as to why the project is being built, what will be the tokenomics, how do they expect it to, what is the future roadmap for the project to grow. So after that, in parallels, if you see that what is the next step in DYOR, doing your own research, there are multiple approaches that you can take. Primarily, these can be clubbed under three headings. One is fundamental analysis. The other is technical analysis, which is based on the charts and the price movements. And third is sentimental analysis, which is extremely important in crypto because there's a lot of community-based projects that are being built. First of all, let's talk about fundamental analysis. This includes, studying the white paper, reading about the project, or generally trying to understand what the project is solving for and its future potential as well. In technical analysis, you look at, price charts and use like different technical indicators, patterns, or sequences to predict future prices. And finally, in sentiment analysis, you need to check how there's been an uptake on social media platforms, on how the project is doing within its community. Is it generating buzz in the community, and like other intangible aspects of how a project is run. This becomes extremely important because a lot of these projects are governed by the community, they are owned by the community. So like a Discord channel, a Discord server where the community is discussing as to what are the next steps becomes extremely important for you to understand where the project is going. So if we had to like actually rank these DYOR approaches, like the three fundamental, technical, and sentimental, I would say in terms of relevance, fundamental analysis still remains the most relevant because that actually gives you the base as to what the project is trying to do. This can be followed by sentiment analysis, which is a more, I would say, sticky parameter, because the community that gets involved in a project usually sticks around and drives the way forward for the project. And finally, there is a technical analysis, which is very based on charts and extremely short term as well, like where you basically can predict the price movement for the next hour or so, or maximum day. So again, the first step would be to do fundamental analysis, and for that, again, I go back to the first step in general is to read the white paper of any particular project. A lot of people ask this question as to how crypto DYOR is different from stock market research. So again, like this is a very common parallels that people try to draw, but a good DYOR approach requires you to understand how the project will fare in the long run and how many people might actually be interested in investing in that project. Therefore, the future value of a token, directly or indirectly, depends on the number of people that will be using that network, using that platform, or using that particular token within a platform. Another difference from the stock market would be doing tokenomic specific research. So in the stock world, the analysis is primarily driven by discounted cash flow, which is again like a future prediction of cash flows for the particular stock. In the crypto world, you should probably look at two of these parameters. One is in terms of future projections of demand for that token, and on the supply side is where tokenomics kicks in. So tokenomics is again unique to crypto projects, where you basically have to understand how the supply of the token will increase over time or decrease over time. Who all will be the holders of the token when it's launched? When will they be allowed to release those tokens in the market? And some of this also ties up with the credibility of the team. So in most token projects, a lot of the tokens are initially with the founders and the initial investors and developers. How these tokens are released into the market gives a great sense of how much confidence these people have in the project. So that becomes an important parameter to look at while you're doing DYOR on a token project. In the beginning, I've also talked about sentimental analysis, and a lot of people ask as to how you should go about sentimental analysis. So specifically, as I mentioned in crypto, it's important because it is like a lot of these projects are community owned and they are community driven. So you do need to have a decent amount of knowledge as to how these communities are building amongst social media platforms. Would include Twitter, it would include Discord, any Telegram groups that you could join, and basically any blogs or Medium posts that particular project is doing. So there are other online tools and techniques as well to measure market sentiment. There's something called the Crypto Greed and Fear Index, which gives you a sort of a sentiment of the market in general. So whenever you see excessive fear is when you should be looking at investing. Whenever you see excessive greed, you should be looking at selling the markets. Then another interesting concept that we should probably look into is on-chain data, which is unique again to blockchain-based token projects. that also give you a great idea in terms of how the community or that platform is being used in real life. So I would take a moment here and talk a little bit more about on-chain data. On-chain analysis is basically an in-depth analysis of a coin's blockchain data and is more fundamentals driven approach. So what it does is it involves getting insight into the network activity that happens on the exchange, and the amount of transactions and value transfer that is happening on the network. It also gives you some data around how many people have been holding those tokens for a longer duration of time, and whether those tokens are being moved from the chain to exchange wallets. So all this data is publicly available for most public blockchains, and it has like a huge ramifications in terms of determining where the price of the token is going to be. Specifically, if the next question is around, can you mention any important on-chain data or matrices that users should follow? There are several of them, and like you would probably the best source for any on-chain data, specifically for Bitcoin and Ethereum, is Glassnode. And Glassnode actually comes out with a very regular blog post as well, where they talk in detail about these on-chain matrices. Some which can be like, I can think about the top of my head, are network value to transaction ratio, market value to realized value ratio, liquid versus illiquid supply ratio, and several others. But the most basic and the ones that everybody should be aware of are two on-chain matrices. One is BTC inflows to an exchange, inflows or outflows to an exchange, and the other one is the number of active wallet addresses. So I'll try to elaborate on these two a little more. So inflow to exchanges is a great metrics to understand what the demand supply flux of any particular asset is. I'll take Bitcoin as the example here. So if the supply of Bitcoin into exchanges is failing to keep up with the demand, or basically it's outweighing the sellers, it is a sign of strength for the market. Even in most cases, these exchange wallets are hot wallets, and if somebody wants to store his Bitcoin, he would want to store it in a cold wallet for longer duration. So let's say if there's an outflow from exchanges, that generally represents that people are going to store their Bitcoin for the longer term, which again is great for price action, reduces circulated Bitcoin supply, which is available for new buyers to enter the market. On the other hand, the exact opposite is when there is a increase in inflows to the exchange. This is a sign of investors are losing appetite for the token and are ready to go to exchanges to sell them. This primary parameter is very basic to understand how long-term holders are looking at positioning themselves. Another similar metric that you can find on chain, especially for BTC and ETH, is the number of active wallet addresses, which shows the demand or usage of the blockchain network. Active address count can also be used, to further drill down and look at, on-chain transactions, how much value is being moved on chain, or what is the fee that is being generated on the network. So specifically for Ethereum, we have seen in the past that whenever the network usage really increases, the fees also jumps up a lot. And this generally shows that there is a lot of demand for transactions on that particular network, and is usually followed by a period of price increases. So for Ethereum's case, we saw this happening in 2020 and early 2021, where DeFi and NFT built on Ethereum was really exploding. Network fees was very high, and subsequently Ethereum prices also moved up. A fall in active addresses also signifies that there is a drop in usage of that particular blockchain network, and it could also be looked upon as a period of bear market, where the active number of wallet addresses that are on a network, they keep on reducing. Is analyzing on-chain metrics important? I think it's a part of the fundamental analysis and is very important specifically for blockchains, because this data is available publicly. As the crypto market grows, traditional ways of analyzing market sentiment may become like less efficient in terms of working, and there might be large deviations from what you observe in sentimental analysis versus where price action goes. Therefore, you need to go an extra step and do the analysis at a fundamental level. And that's where these on-chain indicators become extremely important. This will sort of give you like an edge over other investors who are just looking at social media posts or influencers before making investment choices, versus on-chain data provides you like a more fundamental approach where you can look at it as a long-term investing. Similar to that, like another question that we get is, what are the best crypto research tools available in the market, and can these be accessed for free? So although there do exist like a lot of paywalls in most of these database or data providers, but I would say like an ample amount of them are still free for usage for all. Basic coin level data you can get at CoinMarketCap or CoinGecko. These are the two sources that you should refer to. Just get the basics of what's the rank of what particular coin, what is the market cap, where all is it listed, what is the circulating supply, and things like that. For more in-depth analysis, you can have like, as I mentioned, Glassnode is a great tool for on-chain data. Then there is Q, there is Nomics, which provides you like another huge level of data. For Ethereum, there is Nansen, another company that's focused just on Ethereum-based data. And again, like there are very niche data providers looking at different sectors. Like say for NFT and DeFi, you can go to DeFi Llama, you can go to DApp Radar, and there's another one called Crypto Compare. All of these are like different data sets where different on-chain data is available. Particularly for Ethereum, I would also say another free tool for all to use is Etherscan, which gives you details about each transaction on the Ethereum network. Most of them are free, at least on a basic level. But if you want to get like more in-depth analysis, then you will have to cross the pay. The next question that we have is, being a highly volatile asset, there is a lot of confusion on how many tokens one should have in their portfolio, or is there an ideal number of tokens that you should have in your portfolio? Well, this is a point of debate amongst investors. While some say that because it's such an early stage asset class, you should diversify with at least like 20-30 coins and try to make the right bet. Whereas others say that you should have like a more concentrated portfolio based on your beliefs in one particular project. However, the basic rule of thumb that like I like to follow and also you should try to look at is never invest like more than 10, 15 or 20% of your total crypto investments in one project. In that ways, it reduces the risk of asset concentration, and also helps you in managing risk and reducing the impact of market volatility of one coin on your overall crypto portfolio. So let's say even if you want to keep 5 or 10 tokens, make sure that not one token has more than 15 or 20% exposure within that. The second rule, which is I think much more important, is that of your overall asset portfolio, you should only put 5% in crypto. The reason for this is because of the volatility in crypto as an asset class. So if you are going to be a part of the bull run, this 5% will become 20%, or it will give you like asymmetric returns when the bull run happens. However, during the downturn, you are not affected as bad if you had like a larger exposure to crypto alone as an asset class. So try to use this as a rule of thumb. And I'm not the only one who's saying it. Like there are prominent investors who come out, especially for BTC. They try to compare it, portfolio allocation to gold at 2%. So Fidelity, as one of the in one of their papers, has suggested it. Great investors like Paul Tudor Jones, Stanley Druckenmiller, George Soros, all of these have come on out of the limb and like put out a word saying that 2% of your portfolio in BTC could be a good inflationary hedge. So what are the key elements you should consider while investing in crypto assets? First and foremost, I'll go back to this point, do your own research, or DYOR, before investing. Because this is extremely important, because understanding the risk reward ratio, diversifying, always having plans for entry and exit, they become important in such a volatile asset class. uh, as I mentioned, that crypto is a very volatile asset class. How should one tackle their investment strategy, or change their investment strategy to account for this volatility? So market crashes and deep corrections are unnerving events, but they are sort of like normal parts of any asset class, and more so for crypto because it is an asset class that's trying to find its value. This all becomes very relevant in today's time and age, when we've seen almost all crypto assets have fallen down over 70% from their all-time highs. Uh, you have to understand if this is happening because of this change in the fundamentals of the market, or is it being driven by more external factors. If it is part of like a more broader macro cycle, then you need to prepare for an extended period of sideways or downwards movement in price, and sort of build your portfolio for the longer term. The current situation, what we are facing, is sort of like a blend of external and internal factors that is affecting the crypto markets. Externally, global macro is on a very weak footing. We have just come out of a phase of tremendous amount of quantitative easing, where liquidity was released by central banks. And now we are facing the problem of inflation, for which central banks are trying to negate it by raising interest rates aggressively. Whenever interest rates go up, risky assets have to fall. That's exactly what we are seeing in crypto, because it is like a major risky asset class. And internally also, because of this price fall, what we have seen within the crypto markets, there was a lot of leverage, which has been drained off because of the fall in prices. And there have been some solvency risk issues within the ecosystem. So that in itself is also driving down prices further. In terms of understanding where we are in terms of the market cycle and investing, it will allow you to have like an opportunity to evaluate your investment strategy and risk profile. It helps you improving your learning curve and getting better prepared for future market corrections. Please remember that corrections and crashes, they will continue to happen, but generally they are also followed by periods of bull run, or the opposite swing of the cycle. I look at it, bear phases as the time where new projects are being built, and also a certain amount of froth in the ecosystem gets washed away, where tourist money or people who had just come into for quick returns, they leave the markets, whereas long-term investors continue to set the floor. This is very important, from the current context as well. And probably we will be in an extended period of downwards or sideways movement in terms of price action. But the long-term, investment thesis for crypto as an asset class and digital assets in general is only getting more strengthened by the amount of institutional interest that is coming in, and hopefully regulations will follow soon. Thank you.
Well, that's it from us. Hope this was all informative. Now do write into us at ETMarkets Crypto Corner with all your thoughts and questions. From all of us, goodbye.
Crypto products and NFTs are unregulated and can be highly risky. There may be no regulatory recourse for any loss from such transactions.